Hi, would you invest in the company that literally powers Kenya? In today's Talk of the Week series, we are speaking about Kenya Power Limited Company, and we want to break down KPLC and see how the stock performs in the market so that as a new investor, you have as much information before you decide to venture into investing into KPLC stocks. KPLC is a company that distributes electricity in Kenya. It does not generate electricity, it just deals with distribution. And it is what we call as a turnaround stock, which means that it is a company that had previously experienced losses, but it is now coming back in terms of financial performance to making profits. So it is turning around in simple language. What does KPLC actually do? We need to know this so that we can know the source of our dividends and all that. So KPLC distributes electricity across Kenya. They connect homes and businesses to the grid, and they collect electricity payments. So that's basically how they make money. Why are so many investors talking about the KPLC stock at the moment? It's because KPLC has a monopoly position. This is because it's among the main companies that distribute electricity in Kenya. Therefore, it has that stable position in the energy sector. Secondly, it has the government backup. Part of Kenya Power is owned by the government, which means it is stable and there is low risk of collapsing. Thirdly, is because of what we mentioned earlier, it is a turnaround stock. So from the past, it has been making losses, but recently on the financial performance, most investors can see that it is performing well and it is a good stock to give it a go. That's why most people are speaking about it and are keen to consider. Let's look at the risks involved. We all know that even big companies have risks, and smart investors consider both sides. We don't want to just look at the good side and leave aside the risky side or the bad side. We want to, look at both sides before we make an informed decision. The first risk is political interference. There is high debt levels and past management inefficiencies. Those are some of the risks that Kenya Power faces. Who is it suitable for? It is suitable for long-term investors. It is suitable for risk-averse investors and short-term traders. Because of the volatility of the market, you can use the stock to earn your capital gains by buying low, selling high, because it is very volatile, and that way these traders can take advantage of that. If we look at the numbers in terms of the PE ratio, which is the share price divided by earning per share, we find that since KPLC is a turnaround stock, the PE ratio can be very volatile. It keeps going up and down, which may not be a good measure to check if the shares are overvalued or if the company has a potential for future growth. So maybe let's use another approach. Let's use debt to equity ratio, which is debt divided by shareholders' equity. This debt to equity ratio shows us how much the company relies on borrowed money. If it is greater than 1, it means that the company is highly financed by debt, and if it is less than 1, it shows that the company has a lower leverage. KPLC traditionally has been having a high debt load, and that's why this debt to equity ratio is key. And its big risk is not revenue, but it is high debt. Another thing that I may mention about KPLC stock is that it is a utility stock, which means it provides essential services like water and electricity. One thing with utility stocks is that they are mostly stable, regulated, but they have slower growth. Therefore, all this said and done, this is information meant to help a new investor to make informed decisions, but is not investment advice at all. This is just meant for educational purposes. If you want to understand the Kenyan stock market in a simple language, subscribe to our channel, Build Your Wealth Hub, and every week we break down a stock and also offer simple financial tips. Thank you for watching up to this far, and bye for now.